This entry in the Path to Electronic Trading series is sponsored by CQG.
Well, I started looking at stock options about 74, but really about 1980 was when I really did the jump, and I started with stock options across the street. And then on the stock option side, I was looking at delta neutral spreads. And I thought it was manna from heaven because I could desensitize myself to price. But, excuse me. What I ended up looking at, I thought I didn't eliminate variables, I changed variables, right? I got volatility now. So I thought maybe I should look at price. But everybody I would talk to at the exchange, nobody looked at price because you'd manage your position with the Greeks, right? If you're making a market, you're just going to adjust accordingly. And I thought, who looks at price? These guys at the Board of Trade. They do these charts and all this other stuff. And so that's what I came over here in a rice seat, excuse me, for floor access, really. But that experience changed everything for me later on. It started with conversations with Rama Pillai here in Chicago. Rama, I have to tell you, I was so impressed with the approach that he used for this whole concept. And we had a few meetings here to talk about what he was trying to accomplish in Singapore. The idea was that at some point, the floor may close there. And nobody had a time frame, but they wanted a way for people to make a transition. And I was teaching courses for the Board of Trade, for the Merck, CME, for New York, a Mercantile Exchange, the COMEX, the New York Board of Trade, on some of those issues. How do you go from the floor to a screen? And the big challenge was that exchanges would assume that if someone trades on the floor, therefore they trade on a screen. But it's two different business models. On the floor, you're a market maker. On a screen upstairs, you're a trader. So your references, how you use information, totally different. Your purpose for existence is totally different. We can talk more about that if you like. But the issue that let's go back to Rama. So we had some meetings and he was talking about trying to provide information. What impressed me so much is that, one, Rama just let me create the courses that we looked at. And then I also used feedback from surveys to help fine-tune those courses for the traders on the exchange floor. But when I first went to Singapore, what Rama did that impressed me so much is that he started out with me having a meeting with the board of directors. So he had buy-in from the top as he tried to implement this program, which I thought, that's a great idea. Not many people do that, but it's a great idea. Because what we had seen in the past was that if you look at Life, if you look at Matif, SFE, the probability of someone on the floor making it on the screen is actually less than 10%. It doesn't have a high probability of success. So we started with the board of directors, and what Rama also did was that he had me meet with banks, he had me meet with brokers, he had me meet with exchange personnel to talk about for an off-the-floor trader, if that happens when the floor would close, then what should a clearing firm do? How do prop trading operations work? And how should they charge for that? And what should be the relationship? Whose money is it that's going to be traded? And all those different models that are possible to do that. So that I was impressed with too, because he looked at the broader scope of everyone that's going to be touching or impacted if there ever is a transition from the floor. So I thought that was interesting. And I think that approach had a big impact on what was going to happen. Now, the courses themselves, the courses, the way I developed, I don't know if you want to talk about that, but the way I developed that was we had a course on technical analysis and on market profile and on what I call trading in the eye of the storm, your mental attitude as a trader. We had courses on what I call behavioral Japanese candles, which takes me back to the floor. That's where that concept came about, which I thought could be helpful to them. And we did a course on options. So we did a few different things for them. And then again, the survey feedback, I would allow that to kind of shape how we're going to be talking about things. The other thing we did, which I totally loved, is the classes occurred after the market closed. So they gave me a little room on the floor of the exchange, and I mean little like a closet with a tiny desk and 2 chairs, but I could set my computer up. The guys and the women could be in the pit, talk about some of the references that we discussed previously, and they could come into the room and say, okay, I'm seeing this. What does that look like? And then we pull the chart up and say, okay, here's what that represents. Here's what it looks like. Here's some references you might want to think about. So it was a wonderful opportunity for me because I thoroughly enjoyed that. But hopefully it really cemented some of the ideas together. Because I felt, if we go back, I felt that the critical part of someone going from the floor to a screen is understanding the differences. On the floor, you're a market maker. On the floor, you're going to buy the bid, sell the offer. That's the whole intent. And so if it's a 5-6 market, anytime you and I see a 2-sided market, we know there's market makers. So it could be futures, it could be options, it could be swaps, it could be a currency desk. All the institutions that I deal with all have 2-sided markets because they're market makers. So what we know is that a market maker's job is to take the other side of order flow that comes into the pit, right? So if you have an order that says, I want to buy one at the market maker is saying it's a 5-6 market, I will sell you a contract at 6. And then what they do immediately is they try to buy it back at 5. And theoretically, the market rotates back and forth about 85% of the time. So about 85% of the time, you could make that difference of a tick. In Treasury bonds, that's $31.25, 25 cents to clear your trade, so you're making about $31. If you could do that a few thousand times a day, by the end of the week, it kind of add up. So that 85% of the time, getting this edge is why somebody would spend $1 million to become a member of an exchange, because you get that business franchise in that sense. But I also said 85% of the time, so it means 15% of the time you're not going to make money. And where the challenge comes into play, where risk management is critical if you're a local or a market maker, is that it's 5-6, 5-6. The person wants to buy one at the market, they sell it at 6 and it goes 7-8. So now they're scrambling to get out at 7 or 8. More order flow comes in to buy. It's 7-8 now, they sell 8s and now all of a sudden it's 9-10. So a directional move, market makers traditionally would lose money. So that would be the typical model for someone on the floor. Now, on the screen, it's a different situation. On the floor, when the market maker is going to trade, how much they're going to trade, what market they're going to trade, the order flow really determines that. You don't have to make those decisions. It's if the broker's hands are in the air, you're going to be busy. If they're not, you're not. The two issues here is that when you're on the screen, you're making all those decisions. The other thing that I found helpful is this. We talked about the market maker selling 6s, buying 5s. That means they're in and out in a flash. They don't have necessarily an opinion about market direction. They just want that 5-6, 5-6 market. So they're in and out. So do they have an impact on a long-term trend? I don't think so. But what may determine that trend is the order flow that came in. That order to buy one at the market, that person still has a position. They've expressed an opinion. And you and I would see that as a print on a chart. So it's that analogy that I used in the courses that I taught, so that someone on the floor can now relate to, this is what we're looking at. One, it's that you're not a market maker on a screen. There you're competing with computers, incredibly difficult to do. So if you're going to try to do the same thing, it's hard to do that. If, on the other hand, you can now look at it from the point of view, a new business model, where you're now a trader. Now you're going to decide when to trade, how much risk, how much profit, how long to hold the position, all those parameters. As long as you understand that and you have it put together, I think your probability of success starts to go up, because then you have an appreciation of this new business model. In fact, one of the courses I taught was how to build a trading strategy. How do you build it, evaluate it, and implement it? Which are all the critical questions that you and I would need to take a technique and turn it into a strategy. So how much profit's acceptable? What should I expect? What's my expectancy? What's the risk that I have to take to hold this position? How long should I hold this position? How patient should I be? What's the frequency of this trade? How often does it occur? Is it stable in trending sideways or downtrending markets? If you and I have those questions or understand how to get those questions, again, our confidence level starts to go up, and so does our comfort. And that was kind of threaded into all the courses I taught there. We also had one on just the transition from the floor to a screen. And it was comprehensive. Again, going back to Rama brought in all the associated communities. The floor personnel came through these classes as well, because their life was going to change if that floor closes. The exchange also implemented something that I thought was very helpful, and that was they had an electronic arcade, in a sense, in the exchange building. Very large room that had computers, that had the market up in front on a large screen, and now you're sitting at a computer trading that market to help that transition, which I thought was really critical. So, what also amazed me is that Rama had mentioned to me that the traders that have made this transition, about 85% of the people that were in the market are still in the market, which is wonderful news, I think, for the industry in total and for those people. And I also want to emphasize my part was very small. I maybe shared some ideas that I hope help them, but the fact is they're doing the trade. The fact is that they're, making this happen for themselves. I think our first class was around 2004, and I was there every few months until 2006, 2008. So I was going there regularly to hold these courses. And it was, again, it morphed over time according to the questions I would get. So then I'd make sure the next time we did that course that we had those questions built into it to help that. And I have to tell you also, the enthusiasm of the traders, of the market makers, that the locals that came to these classes was exceptionally high. And maybe it was because of the motivation of knowing things may change. Maybe that also helped with that. But the questions I would get, the sincerity that I would see when I was on the floor, when they would come into the office, it was right on target. It was, they're obviously motivated, listening and trying to implement some ideas.